Financial accounting is imbued with what are called accounting principles. And these are the principles that will guide you throughout the entire course because they are supposed to be applied. So these accounting principles range from what we call the entity assumption principle, the going concern, the periodicity assumption, the money unit assumption, the historical cost principle, objectivity principle, the revenue realization, matching, consistency, disclosure, and prudence principle. So quickly, we'll go through each one of them and what they entail. So to start with, we have what we call the entity principle. This principle simply states that an organization is a separate entity from its owners, meaning the personal affairs should not be meddled with the business affairs. So if you have a company and you find the director using that company over the weekend and it's not required in that particular company, you can sue that individual because the owner is separate from the business. Then we also have what we call the going concern, which simply states that we should always assume that this business will go on forever. So this entails that if you know some people who are running a business and they died today, consider that business to have a going concern such that even in 2020 or 2022, you assume that it's still going on and beyond. So a going concern really assumes that the business has a foreseeable future. And the periodicity concept simply asserts that you should always report the operations of a business over a standard period of time. It can be a weekly, it can be monthly, or semi-annually, or at the end of the year, half a year. It's important that you show the period of time covered by the report as a heading. For instance, we'll look at what is called the trading profit and loss account, which collectively is called the income statement. It is usually stated at the year ending. So the year ended for a particular organization differs. Some end at December, some at August. So you need to understand the period of that particular company. The money unit principle simply asserts that we should always record transactions in monetary forms, not in terms of goats or gold. It must be in monetary form. So all monies should be assumed in that for uniformity's sake. Then the historical cost concept simply assumes that all assets and liabilities must be recorded at the acquisition price. If we acquired land at 50,000 and now the market value is 100,000, still the asset should hold the balance that you bought it for at 50,000. So with these first 5 principles, maybe let's look at this activity. I need you to align the principle with the numbers that we're going to put here. So the company's balance sheet should report its land at the price you acquired it. Which of these principles are we considering here? Entity, going concern, periodicity, money unit, or historical cost? Which principle?
Monetary.
Monetary, are we agreeing? We should value it at the land at the price we acquired it.
Historic.
Pardon?
Historic.
Yes, historic 5. Then a company should cover a specific period of time. What principle are we talking about?
Periodicity.
Periodicity, correct. Personal assets of the owner should not appear in the balance sheet.
Entity principle.
Yes, you need to separate the affairs. Then the business should remain in operation for a foreseeable future.
Going concern.
Going concern, which is what? Number 2. And finally, transactions should be recorded in unit of currency.
Monetary unit.
Monetary unit, of course. So these are quiz kind of questions that you need to understand. So it's really important that we don't skip this, but they'll be very vital as we do the calculations. Then objectivity principle simply requires that as you are reporting a financial report, the information must be independent of bias. You need to be objective as you are making. It will help you make your reports more reliable. The revenue realization simply assess that the price that you paid your services, or that are supposed to be paid for your services or goods, should be recorded, not when you receive the money, but when the transaction was entered. For instance, if you supplied your customer goods worth 1,000 today and they pay next year, you need to record revenue as being made today, not when the monies have been paid after next year. The realization or the matching concept is also called the accruals principle, which means that costs, the matching principle simply states that costs incurred must match the revenue earned in the same period. So this means that you cannot charge costs that are not incurred in that particular period. Costs must be matched within the same period. The consistency principle simply asserts that you need to adopt one standard accounting principle, a method that you continue to use throughout the reporting. You can't use one accounting standard and another. Disclosure principle simply asserts that you need to provide all the relevant facts that you need for disclosure purposes. You need to also add underlying notes that may enable the reader understand and make informed decisions about the company. And finally, the prudence principle simply asserts that you need to be careful whenever you are reporting. You need to be cautious in the sense that should any situation be acceptable, you need to choose the best available alternative, which has less detrimental effects on the company itself. So this principle makes sure that you don't overstate your assets or underestimate your liabilities and the expenses. So quick, can you remember what have we learned? We've said that the entity assumption simply says that the owner and the business are two different. The going concern simply states that the business will remain for a foreseeable future. Periodicity simply states that you report your results within a designated period of time. Monetary unit principle simply states that transactions should be expressed in currency form, for instance, kwacha. Historical principle, the price must be based on its original value, not the current value that has appreciated. Any questions so far? Are we together? Are we following? Are we together so far?
Yes, we are, thanks.
Then the consistency principle simply need to adopt one method throughout the year for the accounting period. Disclosure says you need to provide all necessary information to help you make informed decisions. And the prudence principle simply says that we should not underestimate our assets. We should not overestimate our assets or underestimate your liabilities and expenses. These accounting principles are very important. So quick, can you remember all transactions of a business should be recorded? What principle is that? Brian Bell started a business. However, he's not around, but is still in existence. What principle is that? Going concern. Accounting reports must be reported every year. What accounting principle is that? Okay.
Periodicity.
So you will have that as your homework. Now, we move to the books of original entry and prime entry. These are very important. So in financial accounting, there are what we call books of original entry. Now, books of original entry are books where we first record transactions for the first time. For instance, when somebody makes a payment, we make it in the cash receipts, in the checks, and also payment vouchers. So these ones provide primary information, which we call the books of prime entry. So books of prime entry, we use what are called journals or the cash book. Then there are also what we call secondary entries, where we tap information from the books of original entry and summarize them into books that are called ledgers. So ledger accounts use what we call a T or horizontal method of entry. So this takes us to one important other book, which is called the ledger. So in the ledger, we're going to learn the principles of double entry, which are imbued in it. Now, a ledger is simply, in small terms, it's a book of accounts. So we have different types of ledgers that you need to know. There's what we call a sales ledger, there's what we call a purchases ledger, there's what we call purchases returns ledger. Now, the accounting equation must also be put in mind that our assets must be equal to the equities plus liabilities. If the liabilities go there, we can just change the subject formula to say assets minus liabilities is equal to equity. Now, at this point, at least we must know what each of these variables are. Assets are what we own. Liabilities are what we owe. Equity is the money that we started with. It's called capital. So assets can be fixed or current assets. The fixed assets are simply assets that are used for business use in a company. Vehicles, fittings and fixtures, land, buildings. Then we also have what we call the non-current assets, which are the non-current assets are actually the fixed assets. The current assets are simply what we own that can easily be converted into cash within a year, like cash itself, cash at bank, stock, prepayment, and our debtors. And liabilities can be long-term or current. Current liabilities are simply what we owe that can be paid within a year. And what can be paid over a year are called non-current assets, which include bonds, debentures, and long-term bank loans. So this is what gives us what we call the accounting equation. Now, I covered all this in Unit 1, where we discovered and taught all these key concepts. So today I want us to learn how to do the ledger accounts. Now, ledger accounts are very important because they will help us understand how to post to another book, which is called the trial balance. An account is simply a record of transactions that involve a particular item. So we're going to look at the three types of ledgers. There's what is called a nominal ledger. A nominal ledger contains items that pertain to impersonal accounts. For instance, a wages account, a electricity account. So these are transactions that can be posted in what we call a nominal ledger. So before we go into posting of these accounts, we need to identify how T accounts look like. In a layman's language, a T account has the left side and the right side. The left side, we call it the debit. The right side, we call it the credit side. So the principle is as follows. The debit side increases assets. The debit side increases expenses. The debit side will always increase purchases. The opposite, the credit side will increase liabilities. The credit side will increase sales. Credit side will increase accounts receivables like gains. So we need to identify what happens on the left side and what happens on the right side. What is increased on the debit side and what is decreased on the credit side for us to understand how these T accounts will go. So on the debit side, we'll always increase what? Purchases. There's a principle which says debit the receiver, credit the giver. So I'll tell you how we're going to apply that. But for you to remember, we have a simple term which is called PEARLS. Simplifies everything. PEARLS. So purchases are always debited. Expenses are always what? Debited. Assets, when we're increasing them, we debit them. But when we're increasing revenues, we are crediting revenues like capital. When we're increasing liabilities, we're increasing shareholders' equity. So we're going to look at a few transactions here and how they are treated in what we call the ledger. We're going to look at a few accounts and how they're treated in what we call the ledger. Being in mind that we are going to have a horizontal ledger account where debit whatever we receive, credit whatever is going out. So here is where we're going to apply what is called the duality concept. Now, the duality concept simply states that for every transaction, there are two effects that happened. For every debit entry, you should have a corresponding debit entry. For every debit entry, there should be corresponding credit entry. There are always two things that happen. So this is what we call the principle of double entry bookkeeping. In the previous sessions, we had identified what assets are. Who remembers what are assets? These are things that we own. Liabilities, things that we owe. Equity or capital, the startup money that we use. Income, expenses. So these ones we defined what they are. So with these key 5 categories, we are now going to use our examples to illustrate how the following will be classified in. So for instance, we're going to look at assets that are debitable. Now, if we're going to deal with an example, we're going to look at one of the following transactions. Okay. We're going to look at illustration 2. So we're told that BR started a business with 20,000. So there are going to be 2 transactions that we're going to open using this very statement. So BR starts a business with 20,000. So we're going to have a capital account and a bank account. So which account will be debited and which account will be credited? So capital account, 20,000. Okay, then we go to the cash account or the bank account, depending on where the amount will be placed. So capital begins with the 20,000. Then we're going to debit this account in the asset account of 20,000. So we have a duality concept which is completed. The second one is saying we paid 15,000 cash into bank. So there's a contra entry that is happening within one particular business. Money is being removed where? From the bank account, and it's going to the cash account. So when we go to the bank account, we're removing how much? 15,000. The narration should read as cash. And this cash is going where? Okay. So we're told in this transaction that pays 15,000 into business bank account. So the bank account is receiving a 15,000 and the cash till is giving out 15,000. So from cash, we're going to credit this amount because it is leaving the cash till. So when we go to cash here, we'll go to the credit side. We're going to put 15,000 because money is coming out. And money is going into the bank till. So the 15,000 again will appear. So what is actually the transaction title is the book title of the other. Okay, let me go to the step-by-step examples that I think we looked at last time so that I can illustrate them one by one. Here we have a business which is called Cover Enterprises. So we're going to look at these 5 transactions step by step, and we see the duality concept that is going to be applicable. So we're told that the owner invested 5,000 into the business. So there are 2 accounts here. There's an equity account and a bank account. So transaction number 1, we're told that Cover started business with 5,000 in January 2015. So the rules of bookkeeping states that cash at bank is an asset and equity is an equity account, so, or capital account. So to increase our equity, what do? We are going to do what? We're going to credit that amount. Then cash at bank, since it is receiving, we're going to debit it. So this title of this book will be the transaction in the book of bank. The bank, we're going to write it as a transaction in the equity account. Transaction number 2 stated that the business purchased a second-hand truck for 3,500 on 2nd January. So now, which account is giving out? The bank is withdrawing that 3,500. So we're going to credit. Remember I said credit the giver, debit the receiver. So which account is receiving the asset of the truck? So we're receiving this truck into the business. So 3,500, we're receiving the truck. So the transaction here, we're going to write cash at bank because that is a narration that is buying the truck. I'll do the 3rd transaction and you try the 4th transaction. So we are told that the business buys furniture on credit for 1,000 on 2nd January. So now here are 2 transactions that we're going to look at. Number 1, the creditor and the furniture account. The furniture is an asset, so we are receiving furniture. So in this asset account, we're going to do what? Debit it. The special term we use for creditors is account payable. If there was a name like John, would have written John there. So account payable, what is happening? We are going to increase our liabilities. So since liabilities are supposed to be credited to be increased, we're going to put 1,000 there. Okay. Transaction number 4. We are told that our business borrowed 500 kwacha from the bank to add up to the capital. So what are we going to do? This 500 was borrowed from the bank to add up to capital. So the bank account is going to increase because we borrowed money. So bank cash at bank, 500, we've received money into our bank. But the loan payable account is increasing because we're getting a loan. This loan payable is a liability. So to increase liability, we do what? We credit. Then we're told that the business buys stationery with check 4,000. So what is happening here? We are spending. The spender is the bank. So whenever money is going out, we are going to credit. So cash at bank, we are spending money on stationery. So here we put 4,000. But stationery is receiving. So we're receiving an asset into the business in terms of stationery. But where is the money coming from? From the bank. So here we're going to do what? We're going to debit. So this is what we call a T account. This is what we call a T account. Now, with these transactions there, I want each one of you now to give me the 2 accounts that are going to be responsible here. So I'll start with the first 2 since I already showed you. May 1 started a business with 20,000 in cash. So since this is specific in cash, there are 2 transactions here, capital account and the cash account. Capital account is going to be credited because we're increasing our equity, and the cash account will be debited because it is receiving. So we are done with this comment there. The second one, 2nd May, our company paid 15,000 into the bank account. Whenever the transaction is happening within one system we call that a contra entry. So what is happening? The bank is receiving. So bank account, we debited. The cash account, we credited. So who wants to try transaction number 4? Purchases goods on credit from JM for 2,000. Purchases goods from JM for 2,000. What is happening? Which are the two accounts that are at stake? So whenever we purchase goods, we call them purchases. And on credit, it's an account what? Payable. Or we can put JM himself. So the purchases, we're receiving goods. So the purchases account will do what? Will debit it with JM. And JM account, we're going to credit because it's a creditor. So account payable. So we're going to open two accounts. There's what is called the purchases account and JM account. JM is what? Account payable. So since we're receiving goods with 2,000, they're coming in. So we're going to put 2,000 there. Then the title of this book, which is JM, we're going to put purchases 2,000. So this is the duality concept, which says for every debit entry, we should have a corresponding credit entry. Let's go to the next transaction. Purchase goods from ERD on credit at 3,000. This one is a similar one. Can somebody try? Which two transactions are we looking at? We purchased goods from ERD on credit 3,000.
Mr. Collins?
Uh-huh.
Yes, so for this one, the purchase account will be debited,
Mm-hmm.
and then the ERD will be credited.
Excellent. Why? Because ERD is our what? Is our creditor. So purchases account will debit with the 3,000 we're receiving the goods. ERD account, we're going to credit because this one is a creditor. Correct. Who wants to try the next transaction? Paid wages in cash 60 kwacha. Paid wages in cash 60 kwacha. Who wants to try? Dingiswayo. We paid wages in cash 60 kwacha. Which two transactions are we considering? There's a wages account and the cash account. But help me, which one are we debiting and which one are we crediting?
Can I try?
Yes, please.
So we are going to debit the wages account and credit the cash account. So the wages account is an expense, so we debit. Increasing it means we have to debit. Cash, in reducing it, we have to credit because it's also an asset account. So yeah.
Continue with the rent, paid rent by check. They're similar.
Yeah, so rent also we have to debit rent, and then we credit bank. Is it bank?
Yes.
I don't know which account we're using. Bank, right?
Yes. Excellent. Okay. So exactly what she said. For this one here, we have two key aspects. We have the wages and the cash. So the wages, we're going to debit them because we always debit expenses. The cash account is giving out the 60. So when we go to cash, money is going out, 60 kwacha. But this wage, we're receiving the service. So we're going to what? Debit it. So that's how we debited it. And the next one was saying we paid by check an amount of how much? 80 kwacha. So the service we are receiving is rent. So rent, we debited. Bank, we credit by 8. Since the money is coming out, so here we say rent, 8. Then we go to our rent account for receiving the service. But you can see here, the title of the other book is a transaction. Correct. Everyone has to say something. Let's go to the next transaction. 12. Sales goods for cash 210. Sales goods for cash 210. What two transactions are we having? AJ, Chanda, and Chris. Whenever we hear the term sold goods, that is sales. Bought goods, that is purchases. So here, sold goods for cash 210. Which two transactions are we looking at? Quickly. Anyone?
So which one are we looking at? Sales goods for cash 210. Okay, so we are supposed to credit the sales account. No, the other way around. We're supposed to, yeah, we're supposed to debit the cash account, which is, I don't know, bank, and then credit the sales account.
Great. So the cash account, whenever we sell goods, we're receiving money. So cash account is receiving money out of the sales of these goods. So we're going to do what? We're going to debit the cash account and we're going to credit the sales. We always credit the sales account. The sales always have a credit balance. So here sales, we are receiving 210. Then we go to the sales, cash 210. All right. Correct. Sharon, 16th of May, buys furniture for 15,000, but we are paying by check. Which two accounts are we looking at?
The furniture and the bank.
Good, the furniture and the bank account. So which account are we debiting and which account are we crediting?
The bank account is being credited.
Because it's paying out, correct?
Yes.
Meaning the furniture account we're debiting. So if you're not sure which one, at least you should know one of them. This guy is paying, so you need to credit the pair. So bank account, we're going to credit 1,500. For what transaction? The furniture. Meaning the furniture account, when we go there, we're going to do what? Debit, because we're receiving this asset, correct? All right. Then we go to the next transaction. Sold goods on credit SP80. Sold goods on credit SP80. Tamia and Munda. What are we doing here? Sells goods on credit SP58.
Collins, I joined in a bit quite late, so I'm still trying to just grasp what's going on.
Okay, Munda.
Okay. Maybe I can try. So there's the cash account there.
Sold goods on credit to SP for 580. The one we're looking at. Who wants to help?
Can I try? Okay, so sales goods on credit to SP. So the sales account in this case is supposed to be debited. And then the credit account, which is creditors for SP, is supposed to be credited because the creditor has got the increasing it is supposed to be a credit. It's got a credit balance.
So if we sold to SP on credit, is he our creditor or our debtor?
No. He's actually supposed to be our debtor because he's owing us. So we are actually supposed to debit SP and credit the sales account.
Great. So sales always, don't think twice, sales always has a credit balance. We always credit whenever we sales. So the sales account, we're going to credit it. SP, because SP is our debtor. So when we go to our sales, we're going to put SP there on the credit side. Then SP is our debtor. So all debtors have a debit balance. So here we put 580 under SP. Okay. The next transaction buys goods for cash 3,900. I think this one is one Munda was trying to answer. Buys goods for cash 3,900. You can continue, Munda.
So we'll the expense account. So we'll debit the goods account, the purchase account, and credit the cash.
Excellent. So whenever we hear buying goods, that's a purchase account. Cash is paying out. So the cash account obviously is in, we're looking at it. So because whenever we're buying goods, we're spending. So cash account is giving out money. The purchase account is receiving goods. So when we go to the cash account, we'll go to the credit. So purchases, 3,900. Then when we go to the purchases, we are buying what? 3,900. All right. So we're done with the duality concept. We're remaining with a few things. Let me wrap up through. So also go to 24th of May, pays fittings for cash 600. So fittings are a form of what? Asset that we have, like the wardrobes, the fittings, the shelves. So when we pay for fittings for cash, meaning the cash account is paying and the fittings account is receiving the asset. So when we go to cash, we put 600 under fittings. Then this fittings account will put cash because we are paying by cash. For paying by check, we would have put bank there. The same date, another transaction happened. We're told that there's what we call carriage outwards. Carriage outwards is a special kind of cost that is incurred by the business for transporting goods outside. The way furniture or Fencity gets to do what? To incur an expense on us if we buy goods from them. So if we are the ones who are giving the free transport, we call it carriage outwards because we are spending. If we are the ones receiving and we are spending for ourselves, we call it carriage inwards. It's added to the purchases. So pays carriage outwards, costs by check. So we are paying. So check is doing what? Is going to be credited. Then this is an expense, we're going to debit carriage outwards. So when we go to bank, 25, carriage outwards. Then carriage outwards, we're going to debit bank 25. Then we go quickly the next transaction, which is paid wages by cash 110 and sold goods by cash 430. So here we have the cash account and the wages. Cash account will credit and the wages account will debit. Sales are always having a credit transaction. So credit sales and we debit cash because we're receiving. Then May, we see part payment from SP. Now this is interesting. We already had an SP earlier on here. So this SP is our what? Is our debtor. Now he has decided to pay part of his debt. So received payment, part payment from SP by check, which is 300 and what? And 30. All right, so we'll go to our bank. We received 330. So we're going to put SP under bank 330. Now, when we go to SP account, instead of subtracting a 330 there, in accounting, the opposite negate it, it subtracts it. So we'll put it here on the other side as 330 because you subtract automatically when it is on the other side, meaning it's subtracting from this figure there. So we put bank 330. Then we go to the last few transactions. Paid carriage inwards. I explained what carriage inwards is. It's an expense on transportation for buying goods. So paid carriage inwards by check. So meaning the bank account, we're going to credit 20. Carriage inwards, which is an expense, we're going to debit it. Paid advertising by check. The bank account, we're going to credit 20. Advertising, we're receiving this service, we're going to debit it by 25. Sold goods for cash, 890. Sales account 890, the cash account, we're going to debit it with the 890 because the cash sale. Sold good on credit KM. Now, whenever things are sold by cash, we need to have the name there, KM. KM is not important because money is coming into the cash till. But here, if it's on credit, it is important that the one we're selling to who's the data, the personal account is what? Reflecting. So sales will credit, then this guy is a data, we're going to debit him 8090. Then we'll go to withdrawing of cash. So withdrew cash for personal use. So in our first unit, we explain this kind of withdrawal in the business. We call it what? Drawings. Whenever money is withdrawn from the business for personal use, we call them drawings. For instance, you own a cantemba and you get bread for personal use. So those are called drawings. So two accounts we're going to use, the cash account and the drawings account. So in the cash account, since money is coming out, we're going to credit the 100 under the term drawings. So we put 100 kwacha there. Then when we go to the drawings account, we're going to do what? Debit 100. So these other transactions have been done. So this is what we call posting. This is what we call posting. So once you're done with this posting, in the evening, I'll teach you how to balance off and post them to the trial balance. Then we need to start doing the final account. All right, so this is very interesting. You need to understand which accounts go to the left and which accounts go to the right. After we're done with that, we go to posting to the income statement and the balance sheet. Then we work on the adjustments. Then we are done with financial accounting part. Then we go to posting. Now,